The piercing line pattern is a bullish indicator suggesting a potential reversal in the market from a downward trend to an upward trend. This pattern occurs over 2 days, where the first day closes at a new low with a significant drop, indicating strong selling pressure. On the second day, however, the market opens at or below the previous close, but then buyers take control, driving prices up to close above the midpoint of the first day's trading range. This sharp turnaround signifies growing investor optimism and can be a signal for traders to consider entering long positions, expecting future upward movement in the price. It is essential for traders to practice identifying and interpreting the piercing line pattern as part of their trading activities. Being able to recognize this pattern can provide valuable insights into market sentiment and potential shifts in trend direction. Traders should look for this pattern in the context of a downtrend, confirming its validity with additional indicators and volume analysis to increase the reliability of the signal. In conclusion, the importance of continuous learning and adaptability cannot be overstressed in the dynamic world of trading. Markets evolve and new patterns emerge, making it crucial for traders to stay informed and update their strategies accordingly. Regularly practicing pattern recognition, like identifying the piercing line and staying adaptable to market changes, are vital skills that contribute to trading success. Candlestick patterns are a key tool in the analysis of financial markets, offering insights into market psychology and potential price movements. These patterns are formed by the price movements of an asset within a specific time frame, represented visually on a chart. The importance of candlestick patterns lies in their ability to signal potential market reversals or continuations, making them invaluable for traders and investors trying to anticipate future price actions. One classic pattern known as the Dark Cloud Cover is specifically associated with a bearish reversal, indicating a potential end to an uptrend. This pattern emerges over 2 days, where the first day shows a long white candle, indicative of buying pressure and a price increase. On the second day, the market opens at a new high, but sellers take control during the trading session, pushing the price down to close below the midpoint of the previous day's candle. The dark cloud cover is significant because it suggests that bearish sentiment is starting to outweigh bullish optimism, potentially leading to a continued decline in prices. Its appearance at the peak of an uptrend serves as a warning to investors that the current uptrend may be losing momentum, prompting considerations for adjusting their positions or strategies to mitigate risk. Understanding the implications of such patterns, investors and traders can make more informed decisions, balancing their portfolios in anticipation of the potential market movements suggested by these visual cues. The dark cloud cover is a candlestick pattern recognized as a bearish reversal indicator that appears in an uptrend. This pattern is formed by 2 candlesticks. The first is a long white candlestick indicating bullish sentiment, and the second is a black or red candlestick that opens above the first candle's high but closes well into the body of the first candle, typically more than halfway. This sudden shift from buying to selling pressure signals that the bullish momentum may be waning and that a reversal to the downside could be imminent. Visualizing the dark cloud cover without actual imagery can still paint a vivid picture. Imagine a chart where the price has been climbing steadily, represented by a series of long white or green candlesticks. The mood is optimistic, with each day closing higher than it opened. Suddenly, after reaching new highs, a candlestick opens even higher the next day, but the mood changes. Instead of climbing, the price begins to fall throughout the trading period, closing significantly lower than the previous day's close, deep into its body. This sudden change casts a dark cloud over the previous optimism, hinting at a potential shift in trend from bullish to bearish. It's essential for traders and investors to take note of the context in which the dark cloud cover pattern occurs. This pattern is most significant after a sustained uptrend or at potential resistance levels. Although it suggests a bearish reversal, it's crucial to look for additional confirmation through other technical indicators or price movements following the pattern's formation to make a more informed trading decision. Identifying a dark cloud cover pattern involves recognizing specific features related to the shape, size, color, and the arrangement of candles on a financial chart. This pattern is considered a bearish reversal indicator and typically appears at the end of an uptrend. The pattern consists of two candles. The first candle is long and green, indicating a strong buying pressure and a continuation of the uptrend. The second candle is long and red, opening at or above the closing price of the previous green candle, but closing well into the body of the green candle, usually by more than half. The size of the candles is crucial. The red candle must be significantly large enough to overshadow the gains made by the preceding green candle, illustrating a sudden shift in market sentiment from bullish to bearish. The contrast in colors between the green and red candles visually captures this change, making the pattern easier to identify. The importance of the dark cloud cover pattern's position cannot be overstated. For accurate interpretation, this pattern must appear at the peak of an uptrend. Its presence signals that the buyers are losing control and the sellers are taking over, potentially leading to a reversal of the current trend. Analysts and investors closely observe this pattern as it suggests a timely opportunity for decision-making regarding secure exits or short entries. Chart examples of the dark cloud cover pattern in different market conditions would show variations in the size and depth of the red candle's penetration into the green candle's body. Whether in a stock, forex, or commodity market, the key aspect to look for is a strong green candle followed by a significant red candle that closes deep within the green candle's body after an extended uptrend. Visual identification of this pattern, combined with other analytical tools, can enhance the decision-making process regarding future trades or investments. The dark cloud cover pattern is a significant indicator that reflects a change in market sentiment and trader psychology from bullish to bearish. This pattern is recognizable by a specific formation that occurs during an uptrend. A candlestick on a day where the market opens at a high, but closes significantly within the range of the prior day's bullish candlestick. The presence of this pattern suggests that bears are gaining strength and are beginning to overpower the bulls, which could hint at a potential shift in the momentum of the market. The appearance of the dark cloud cover sends a message to traders and investors that the optimism driving the market higher may be waning. Specifically, it signals that, despite a strong opening that suggests a continuation of the bullish trend, selling pressure has emerged to push the prices down, closing the day within the territory of the previous session's gains. This reversal from highs, particularly after a sustained period of bullish sentiment, can often lead traders to reconsider their positions and adjust their strategies in anticipation of potential downward movement. The psychological impact of the dark cloud cover pattern on traders is profound. It can lead to increased caution among participants who may start to question the sustainability of the current uptrend. The pattern suggests that bears have not only resisted further upward movement, but have also successfully pushed back, indicating a growing concern among investors regarding the overvaluation or weakening of the underlying bullish factors. In essence, the dark cloud cover acts as a warning that the balance of power in the market may be shifting, with bears starting to gain the upper hand, and it signals traders to prepare for the possibility of a new bearish phase in the market cycle. The dark cloud cover pattern in technical analysis is primarily indicative of a potential reversal in the market, especially in an uptrend. This pattern forms when a large black or red candle on the second day opens above the previous day's close, but then closes significantly into the body of the prior day's candle. This sudden shift suggests that bears have momentarily gained control over the bulls, potentially signaling a shift in market sentiment. For example, picture a scenario where, after a consistent period of increases, the market opens higher than it closed the previous day. This indicates continued bullish sentiment. However, by the end of the trading day, the price has fallen to close well within the range of the previous day's gains. This visual, when observed on a chart, represents the dark cloud cover. However, it's crucial not to interpret this pattern in isolation. The market context around the formation plays a significant role in determining its reliability as a reversal signal. Factors such as the volume during the days of the pattern formation, the size of the candles, and the price action preceding the pattern can all influence the outcome. For instance, if the pattern forms after a prolonged uptrend with increasing volume on the day of the bearish reversal, it could strengthen the case for a market reversal. Additionally, it's important to watch for confirmation in the sessions following the formation of a dark cloud cover. A continued downward trend in the next few sessions can confirm the reversal signal, whereas a bounce back might suggest that the bulls retain control, potentially invalidating the pattern as a reversal indicator. In summary, while the dark cloud cover is often a signal of potential reversal from an uptrend, its predictive accuracy heavily depends on the surrounding market context and subsequent price action. Traders and investors are advised to consider these factors and seek confirmation before making decisions based on this pattern. The dark cloud cover is considered a bearish reversal pattern that can signal a potential change in the market direction from bullish to bearish. It is important to look at additional indicators or conditions such as trading volume, nearby resistance levels, and the trend preceding the pattern to validate its implications. Trading volume plays a crucial role in confirming the dark cloud cover pattern. An increase in trading volume on the day the pattern forms provides additional evidence of a shift in market sentiment from buying to selling pressure. This higher volume suggests that the bearish reversal has strong market participation and is more likely to be sustained. Nearby resistance levels are also pivotal in validating the dark cloud cover pattern. If this pattern forms near a significant resistance level that the price has struggled to breach in the past, it indicates that the selling pressure at this price point remains strong. The presence of the pattern near resistance adds to its credibility as a signal for a potential downward reversal. The trend preceding the pattern is another vital factor to consider. The dark cloud cover pattern is more significant when it occurs after an established uptrend. This is because it represents a sudden shift in momentum from buyers to sellers, suggesting a weakening of the uptrend and a possible trend reversal. When these additional indicators or conditions align with the presence of the dark cloud cover pattern, they reinforce the signal's reliability. However, if these conditions do not support the pattern, it might weaken the significance of the dark cloud cover as a bearish reversal signal. For instance, a dark cloud cover pattern occurring on low trading volume might not carry the same weight as one accompanied by a surge in trading volume, as the latter suggests a more decisive shift in market sentiment. In summary, while the dark cloud cover pattern alone might indicate a potential bearish reversal, traders and analysts often look for confirmation from additional indicators such as rising trading volume, resistance levels, and the preceding trend. These factors can either strengthen or weaken the significance of the dark cloud cover, making a comprehensive analysis crucial for accurate market prediction. The dark cloud cover is recognized as a bearish reversal pattern seen in candlestick charting, primarily used in technical analysis of stock and currency markets. This pattern consists of a bullish candle followed by a bearish candle, where the latter opens higher than the previous close but closes deep into the body of the first candle, suggesting a potential reversal from an uptrend to a downtrend. Historically, the accuracy of the dark cloud cover in predicting market direction changes has been noted with interest by traders and analysts. It tends to signal a shift in sentiment from bullish to bearish, indicating that sellers are beginning to outnumber buyers. However, like all technical indicators, the dark cloud cover is not infallible and should not be relied upon exclusively for making trading decisions. Its reliability can be affected by various factors including market conditions, volume, and the presence of other confirming signals. Therefore, it is essential to acknowledge the limitations of this pattern. A prudent approach is to use the dark cloud cover in conjunction with other analytical tools such as moving averages, relative strength index (RSI), or support and resistance levels to validate its signals. Combining multiple indicators can help enhance the accuracy of predicting market movements, reduce risks, and improve decision-making in trading strategies. In conclusion, while the dark cloud cover is valuable for identifying potential reversals, investors and traders should regard it as part of a broader analytical framework. Ensuring a more holistic view of market dynamics through the integration of multiple analysis techniques can lead to more informed and successful investment decisions. To understand how the dark cloud cover pattern can be integrated with other technical analysis tools, let's first break down what it signifies. The dark cloud cover pattern is identified when a large black candlestick follows a large white candlestick in an uptrending market, indicating a potential bearish reversal. This pattern alone can signal a change in market sentiment, but its predictive power is enhanced when combined with other technical analysis tools. One could integrate the relative strength index, or RSI, with the dark cloud cover pattern. The RSI is a momentum oscillator that measures the speed and change of price movements, often used to identify overbought or oversold conditions. For instance, if the RSI shows an overbought condition, typically a reading above 70 at the same time the dark cloud cover pattern appears, it strengthens the bearish reversal signal, suggesting that the market could be due for a correction. Another tool is the moving average convergence divergence, known as MACD. The MACD is a trend-following momentum indicator that shows the relationship between two moving averages of a security's price. Suppose the MACD line crosses below the signal line right as a dark cloud cover pattern forms. In that case, this convergence enhances the credibility of a bearish reversal, indicating declining momentum and potentially confirming a sell signal. Fibonacci retracements are also valuable when used in conjunction with the dark cloud cover pattern. Fibonacci retracements help identify potential support and resistance levels based on previous market movements. If a dark cloud cover pattern appears near a key Fibonacci retracement level, such as 61.8%, acting as resistance, it can suggest a strong likelihood of a reversal from the current trend. Let's look at a real-world example to illustrate this integration. Imagine a situation where a trader observes a strong uptrend in a stock, followed by the formation of a dark cloud cover pattern. Before taking any action, the trader checks the RSI and notices it's above 70, suggesting overbought conditions. They then observe the MACD and see the line crossing below the signal line, indicating declining momentum. Lastly, they notice this pattern formation occurs near a significant Fibonacci retracement level, serving as resistance. All these indicators corroborate the initial signal given by the dark cloud cover pattern, giving the trader more confidence in executing a bearish trade. Combining the dark cloud cover pattern with RSI, MACD, and Fibonacci retracements offers a more holistic view of market conditions, allowing for more informed and strategic trading decisions. This multifaceted approach enables traders to assess not just the potential for reversal, but also the strength and momentum behind market movements, providing a comprehensive toolkit for navigating the complexities of the financial markets. Common mistakes and misconceptions traders often have about the dark cloud cover include misunderstanding its components, overestimating its predictive power, and failing to consider broader market context. Firstly, the dark cloud cover is a bearish reversal pattern identified in candlestick charting. It occurs during an uptrend when a black or red candle representing a decline in price opens above the previous day's close and then closes below the midpoint of the previous day's green or white candle, representing an increase in price. A frequent misunderstanding occurs when traders misidentify the pattern by focusing solely on the color of the candles without considering the relationship between the opening and closing prices of consecutive days. Secondly, there is an over-reliance on the dark cloud cover as a standalone indicator for market reversals. While it can signify potential downturns, traders sometimes erroneously attribute too much predictive power to this pattern, ignoring other fundamental or technical signals. This overconfidence can lead to premature or poorly timed trades based solely on the appearance of the pattern. Lastly, neglecting the broader market context is another common error. The dark cloud cover, like any technical analysis tool, does not operate in isolation. Market conditions, volume of trades, and other technical indicators should also be considered to confirm the pattern's significance and potential impact. Failing to do so can result in a misinterpretation of the pattern's bearish signal. To avoid these mistakes and improve pattern recognition and analytical skills, traders can adopt several strategies. 1. Education. Gaining a comprehensive understanding of candlestick patterns, including the dark cloud cover, through thorough research and study. This broadens a trader's ability to accurately identify patterns and understand their implications. 2. Practice. Utilizing historical data to practice recognizing dark cloud cover patterns and other technical analysis tools. Simulation trading can also help refine decision-making skills without financial risk. 3. Use of supplementary tools. Combining candlestick patterns with other technical indicators, such as moving averages or relative strength index (RSI), for confirmation. This layered approach enhances the robustness of trading decisions. 4. Holistic analysis. Considering the macroeconomic indicators and market sentiment indicators that could affect asset prices alongside technical analysis. This ensures a well-rounded approach to trading. By addressing these common mistakes and applying these strategies, traders can enhance their ability to use the dark cloud cover and other technical analysis tools more effectively, leading to better informed trading decisions. Leveraging the dark cloud cover pattern in trading involves recognizing it as a signal for possible bearish reversal after an uptrend. This pattern is formed when a bullish candle is followed by a bearish candle that opens higher than the previous day's high but closes well into the body of the first candle, ideally more than halfway. To use this pattern for setting entry and exit points, traders typically wait for additional confirmation before acting to mitigate risk. For entering a trade, after identifying a dark cloud cover pattern, a trader might look for further bearish signals in subsequent sessions, such as a lower closing or a bearish engulfing pattern, to confirm a downtrend's initiation. A common strategy is to enter a short position when these confirmations occur, setting a stop loss slightly above the high of the bearish candle, forming the dark cloud cover to protect against potential losses if the trend reverses. For exit points, traders might set a target based on key support levels or use trailing stops to lock in profits as the price declines. The logic behind this strategy is that a confirmed dark cloud cover pattern suggests selling pressure is overcoming buying momentum, potentially leading to a significant price drop. A notable case where traders effectively used the dark cloud cover involves the stock of a well-known technology company. The stock had been on a strong uptrend for several weeks when a dark cloud cover pattern appeared on the daily chart. Traders who recognized this pattern waited for the next day's trading to close lower, confirming the bearish reversal. Those who entered short positions based on this confirmation benefited when the stock price declined by 10% over the following week. This real-world example underscores the value of the dark cloud cover pattern as part of a broader trading strategy. By combining this pattern with other technical indicators and a disciplined approach to risk management, traders can enhance their ability to make informed decisions in the market. Dark cloud cover is a bearish reversal pattern recognized in the world of technical analysis, indicating a potential shift from a bullish to a bearish market. It appears on a chart when a securities price, which has been in an uptrend, experiences a significant drop on a day following a day of strong gains. The pattern consists of a long white or green candlestick followed by a larger black or red candlestick that opens above the high of the previous day but closes well into the body of the previous day's candlestick. Variations and similar patterns to dark cloud cover include the bearish engulfing pattern and the piercing line pattern, each with its distinct characteristics and signals. Bearish engulfing pattern. This pattern also signals a potential bearish reversal, but is characterized by a small candlestick, white or green, followed by a larger black or red candlestick that completely engulfs the body of the previous day's candlestick. Unlike dark cloud cover, which requires the second day's candlestick to close within the body of the previous candlestick but not below its opening, the bearish engulfing pattern demands that the second candlestick covers the first one entirely. This pattern is regarded as a stronger bearish signal because it shows that sellers have overtaken the buyers completely through the trading period. Piercing line pattern. As a bullish reversal counterpart to the dark cloud cover, the piercing line pattern is noteworthy. This pattern emerges during a downtrend, featuring a long black or red candlestick followed by a long white or green candlestick. The second day opens at new lows but closes significantly into the body of the first day's candlestick, at least above the midpoint. The piercing line pattern suggests that the bulls are gaining strength and possibly reversing the trend from bearish to bullish. In interpreting these patterns, traders look for confirmation in subsequent sessions before making investment decisions. For instance, following a dark cloud cover, they might seek further bearish indicators, while after a bearish engulfing or piercing line pattern, follow-up candlesticks that continue the newly indicated trend can provide confirmation. Visualizing these patterns on charts, traders would see the bearish engulfing pattern as a large engulfing red candlestick following a smaller green one, while a piercing line pattern would be portrayed by a significant green candlestick opening below but closing significantly within the body of a preceding large red candlestick. These visual cues help traders quickly grasp market sentiments and make more informed trading decisions based on the identified patterns and their variations.